Hi, welcome back to another podcast with Mr. Hagan. On this podcast, I just want to go back to where we finished the last podcast. And one of the items that we had talked about on the last podcast was this idea of per capita GDP. And I said something here. I said per capita GDP was taking the total production in a country and dividing it by the population. And then at the end, I said the number that we got, we had some country that produced $15 trillion of goods and services divided by 3 million people in the population. And by the way, I put a dollar sign there, and I shouldn't have, right? It's 3 million people. So it's $15 trillion of goods and services produced divided by the 3 million people in the country gave an average income of $50,000. Now listen to what I just snuck in there. At the beginning, I was talking about production. Okay, what is the production in the country? And in the end, I was talking about the average income in the country. So how did I make that switch? Well, one thing that we want to say is this. The gross domestic product is measuring really three things. It is measuring directly the total production in the country, the production of final goods and services, et cetera, et cetera. We've talked about that a lot on previous podcasts. So it's measuring the total production, but it's also measuring the total spending that happens in your country. Because think about it this way: every time that something is produced, somebody buys that thing that is produced. Okay, that's in fact how we keep track of production, is by keeping track of spending. So when I go to the store and I buy something, if I go to Home Depot and I buy, I don't know, some new tools, a hammer and some things like this, then somebody, that's evidence that somebody engaged in production. Somebody produced a hammer. So when I go to the store and buy a hammer, that's spending, and that spending must be exactly equal to the production that happened. Okay, so I paid $20 for a hammer. Somebody must have produced a $20 hammer. So the total production in a country must be equal to the total spending in the country, and also it must be equal to the total income in the country. Well, why is that? So here we have some guy, and you know, he produces a hammer. So here's my hammer. Forgive me, I'm not too much of an artist, but there's my hammer, and then here's me over here, and I go to the store and I buy that guy's hammer. He gives me the hammer. He sends the hammer to me, and I send him money. I give him dollars. When that happens, okay, obviously a hammer got produced, so that's going to be part of production. I bought the hammer, so that's going to be spending. And when I spent the money, when I gave the money to him, that became income for that guy. So total production, total spending, and total income, they must all be the same thing. They must all be the same thing. And so we can calculate gross domestic product in two different ways as a result. Because remember, we are trying to calculate total production. So we can calculate that by either calculating the total income in the country. That's your income approach. You can add up everybody's income. Or you can do the expenditure approach, which is adding up everybody's spending. Those are the two ways to calculate gross domestic product. We are going to focus here. You could add up all the income in the country, but we are going to focus on what is called the expenditure approach, which is adding up all of the spending that happens in the country, and we are going to put that spending into 4 different categories. We are going to put that spending into every spending that happens is either going to become consumption spending, investment, government spending, or net exports, and if you add all those up, you get the gross domestic product, which we will designate as Y, which is all the spending that happened in the country, which must be all the production that happened in the country, which must be the gross domestic product. Okay, I just did this all really fast. We will go into detail on how to do this in an upcoming podcast. This has been Mr. Hagan on another podcast. Thanks for joining me, and we'll see you on the next podcast.